Use indexing, not index mutual funds. In this episode, I'm going to explain how to not lose money during market downturns. Get ready. You're going to understand how maximum funded index universal life is probably the best financial strategy and vehicle that you could use for a secure retirement to not outlive your money. So my name's Doug Andrew, and I've been a financial strategist and a retirement planning specialist now for more than 47 years. And my favorite vehicle by far for helping people accumulate money for a long-term goal like retirement, but other goals like saving for college and for the real estate management and so forth, is what I call the laser fund. Now, laser is an acronym that stands for liquid assets safely earning returns. You want a prudent investment strategy. And the key elements of a prudent investment are number one, liquidity. A lot of people put it third or fourth down the list. No, you need to be able to access your money when you need it with an electronic funds transfer or phone call without IRS penalties or whatever. Most IRAs or 401ks trigger penalties if you touch it before age 59 and a half. They do not pass the liquidity test very well. You want number two, safety. Not only safety of the institution, but safety of principle. That whatever I set aside into my investment, I do not want to lose what I set aside due to market volatility. But I have even a deeper definition. Any year I make money. So many people using the strategy I'm about to explain to you in 2017 made 16%, even 25%. I had a client that had $1 million and he made $250,000 that year. The next year, if the market would have crashed, he would not have lost the $250,000 he made in 2017 because you lock in your gains every year. Every time I make money, I want that to become newly protected principal. I don't want to ever lose in the future what I've made in the past. You wouldn't believe how many financial advisors go, "How do you do that?" Yeah. Because they haven't been trained. And then you want to be able to have rates of return, not pie in the sky rates of return, even though indexed universal life has earned many of my clients as high as 61.33%. If they use multipliers, as high as 150% in one single year. But on the average, they earn between 7 to 10% tax-free, which would be like earning 15% in a tax-deferred IRA or 401k, because when you pull out your money at 15%, you're only netting 10. I only have to earn 11 to net 10 in a max-funded IUL. Does that make sense? And that brings us to the fourth feature. It's tax-free, not just tax-deferred. I prefer tax-free because when you defer tax, you're just going to delay the inevitable and you're actually compounding the tax. And I can prove that to you mathematically because most savers are not in a lower tax bracket when they retire. So let me differentiate between indexing and an indexed mutual fund. See, an index fund is where you choose a mutual fund that invests your money in a diversified portfolio in an index like the Standard & Poor's 500 or the Dow Jones or the Russell 2000. So the most common would be the S&P. So if you had an S&P index fund, that means the mutual fund is investing your money into the S&P 500 stocks, okay? In some type of a ratio. And so what happens is like S&P in the worst decade since the Great Depression, 2000 to 2010, let's even go 2 years further to 2012. The S&P dropped as much as 40% or more from 2001 to 2003. It took 4 years until 2007 to make back what you lost because a 40% loss has to be followed by a 67% gain to make back your money. $1 million goes down to 600,000. That's a 40% loss. But 600,000 has to grow by 67% to make up for the 40% loss. It took 4 years to do that. What happened in 2008? People lost 40% or more again for the second time in a decade, and it took 4 more years until 2012 just to get back to the million. So we call it the lost decade because you ended up with $1 million and inflation had eroded away a certain portion of that. You weren't anywhere further ahead. Using indexing, during the down years, our clients never lost a dime. They may not have made much of anything, but they didn't lose. And so they just picked up where they left off. Their $1 million never suffered a loss. And the millions started making money again in 2003, 4, 5, 6, 7. And again in 2009, many of our clients locked in gains of 16% the first 90 days of 2009 after not losing a dime in 2008. So at the end of the same 12-year period, many people that started out with $1 million ended up with $2.5 to $3 million tax-free using indexed universal life. And it was double to triple what most Americans actually experienced with their money in the market. So an index fund is still your money in the market. You're exposed to risk. Indexing is what I just explained to you. Maybe you didn't realize it. That's where your money is linked to an index, but your money is not at risk in the market. It's safely tucked in an insurance company, and they are paying a general account portfolio rate of 4 or 5% on their conservative investments like AAA and AA bonds or mortgages on shopping malls and skyscrapers. And if you decide to link to an index because you feel bullish about America for the next year, you can go link, and it could be November 15th. And you wait, if it's a 1-year annual point to point, until November 15th of the next year. And if the S&P went up 10%, they pay you 10%. They can afford to do that because what did they do with the interest on your money? Your money stayed safe in the insurance company. You said you can have the interest that you're earning on my money. At 4% on $1 million, that'd be 40 grand. They buy upside options, which allow them to pay whatever the S&P does up to a cap or no cap, and they subtract a threshold of 5% or whatever. There's all kinds of strategies that I explain on this very channel. And I'm going to gift you a copy of my most recent best-selling book that explains all of this. But indexing allows you to link your returns. Linking means I'm linking to the S&P, but my money's not invested in the S&P, but the insurance company has to pay me what the S&P does. They do that by buying upside options in the S&P with the interest on my million. But if the economy tanks, I don't lose. My million is still safe. The options expire worthless. I earned 0 that year, but I would rather earn 0 and have it be my hero than to lose 40%. Because Will Rogers once said people get more concerned about the return of their money instead of the return on their money when things are bad. Is this making sense? So indexing is a strategy, not a product. An index fund is a product. When you use indexing as a strategy, you have upside potential, but you have a downside protection if a market crashes. Is that making sense? You'll be able to learn more in the book that I want to gift you at the end of this episode. If this is already intriguing you, subscribe to this channel. Why? Because I have over 500 educational videos and I post at least 5 new ones every single week. So click the bell when you subscribe and you'll be notified every time I post a new video. I appreciate that, but I'm very passionate about providing you with insights into opportunities that maybe you did not know existed before. But see, let me explain that an index universal life policy has the ability to do what I'm talking about if it's structured correctly and funded properly. So when people say, well, Doug, you call it a laser fund. Yeah, a laser fund is designed around an indexed universal life IUL chassis. But not all IULs would qualify or be classified as a laser fund. Unfortunately, a very small percent do because the advisor is not proficient on designing it correctly or helping you fund it properly. If you want to earn, like I have, an average of 11.17% over a 25-year period, netting 10.07, if you want to be able to earn 11 and net 10 cash on cash so that every $1 million can generate $100,000 a year of tax-free income without depleting principal, it has to be designed correctly and funded properly. That's what qualifies as a laser fund, and you'll understand that when you read and study this 300-page book that I'm going to gift you. So let me show you what I've been talking about. I'm going to take that worst decade since the Great Depression, starting in November of 1999. We're going to go 12 years to November of 2012. People who saved $1 million during their lifetime, they felt like they had lost their future when the market went down, down, down. 30, 40%. It took 4 years to come back to break even. And then what happened in 2008? It dropped another 30, 40%. Some people lost 50%. It took until 2012 to come back to break even. Whereas people who use indexed funds, even if they fell asleep and woke up 12 years later, they may not have made anything when the market was going down, but they didn't lose. Zero, zero, zero. 0, 0, but the other years they made money up to a cap of here 15%. The bottom line is most of our clients did way better than this, but you would have had 178,000 instead of still being down to 68,000 when you started out with 100. It took 2 more years before this came up to here, and this one was clear up to where people had 2.5 times their money. That is indexing versus being in the market. This is an index mutual fund versus indexing. Does that make sense? And so when you look at a period, the market performance, this is what the actual market did in 2007, 2008, and it dropped down 38%. And so this is what the actual market was doing. With indexing, you're able to earn a return, and sometimes when the market really crashes, it's 0, but 0's your hero. You didn't lose. You had 512,000 and you still had 512,000. But then it went up 10.5, 10.5, 0, 10.5, which happens to be the current cap for this particular universal life policy. And so that's where you can experience 691,000, where your money in the market still isn't back to the 500,000 that it started out at. That's the power between having money in the market exposed to the risk versus linked to the market. So what's happening, the insurance company, if you have $1 million of cash, every year that you decide to link, if they're earning, let's say 3 or 4% on the general account portfolio, they take 960,000 of your million, and they know that's going to grow back up to $1 million in a year. And that frees up the other 40,000 to buy upside options for an options budget. They buy upside options so that they have the wherewithal to pay you money if the market goes up. They can afford to do that, and there's no losses. If it goes down, the options expire worthless, but 0's your hero, like I showed you on the previous slide. And your general account portfolio grows from 960 back up to $1 million, so you still have the same $1 million you started with. That's why I love indexing. This is simplifying it here on this slide. So if you want to learn more, I would recommend that you study, read, listen, or you can watch and learn. Go to laserfund.com, L-A-S-E-R fund.com, or click on the link below. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll fire out a copy to you. It's actually 2 books in one. This white covered side is 200 pages with all kinds of charts and graphs and explanations. If you flip it over, this is the right brain side, 12 chapters, about 100 pages with 62 actual client stories of how the laser fund is used for all kinds of financial goals. So you can listen and learn, watch and learn. There's even an 18-hour masterclass that I teach if you want to invest in your education there. But this is to your brighter future. I would love for you to be able to take ownership of your own retirement and make yourself immune from taxes, inflation, and market volatility by considering a laser fund for at least 40 to 60% of your retirement income.